Okay, well, let's get in Venugopal Garre, who's with us. He's Managing Director, India Head of Research at Bernstein. Venu, good morning. Good to have you with us here. Wishing you, your team, your family a happy 2026.
Same to you, Prashant, and to the entire CNBC team.
You've the headline first, right? You've cut your view or rating, whatever you want to call it, in India by a notch. You're neutral, Venu.
Yeah,
it's a bit of a non-consensus view because for what it's worth, across the board, if you look at sell side, we've had upgrades, not downgrades, after the lackluster performance in 25, Venu. So your call in that sense stands out. So run us through, although if I look at the nifty targets, etc., it's not as if others who upgraded the view are expecting, a big year in 26. They're all expecting 10, 12% kind of growth. I think your target gives us about an 8% upside. So that's the short preamble. I'd like you to explain, Venu, what led you to this downgrade?
Yeah, so it wasn't planned as a non-consensus view. Probably it just ended up happening like that. But I'll give you a very interesting context. 2024, I'll just bring you back 2 years back when everybody was positive on the market. I had started the year with a book profit call. And interestingly, I had an 8% Nifty return target of 23,500 that calendar year. And we all know what happened that year. Things started to peak off and materially correct in the second half of that calendar year, both from an earnings standpoint and a valuation standpoint. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end and macro is going to start to recover. Rates will start to get cut. We should be selective buy. And selective buy was largely with the view that SMIDs were still very costly. Heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back, and not a book profit call or a sell call, is simply because I guess things are slightly different at this juncture, where macro, while has peaked at around 8% GDP growth rate, is going to only fade out to a 6.5% growth over the next few quarters. So we're not really seeing any major macro collapse. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth. A lot of shift of the burden of economic growth has to shift to private sector, which may not yet be ready to handle that. Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. And lastly, the main point is this, that even this 28,100 Nifty target 8% return was after factoring in 13.5% earnings CAGR over 2 years and using a 19x multiple on 2-year forward earnings. So by the way, that's not like conservative at all, and yet you get a very modest return. So that was a challenge we were finding at this juncture to get returns.
So Street was banking on earnings growth to provide the fillip to the Indian markets to play catch up versus the rest. But clearly 13.5% earnings CAGR over the next 2 years is not going to help us give very strong return. Wanted to get your view on real estate, because you've upgraded real estate after the underperformance seen in 2025. Now, the question is, from 2020, which were the post-COVID lows and bombed out, real estate gave exceptional returns from 2020 to 2024. And we've had only a 1-year period of correction last year where the Nifty Realty Index and stocks were down 15, 20%. I mean, has it corrected enough? What is the call behind real estate?
Yeah, so I'll bring this to a very interesting situation. When you expect broadly high single digit or meager returns in India, it becomes very interesting in terms of how to essentially pick stocks. One of the key things that we saw last year, there was a separate report we wrote in terms of decoding 2025 performance, was the aspect of catch-up trades. So catch-up trades did meaningfully well, which is essentially stocks which didn't do well in 2024, but started to recover in 2025. And honestly, there wasn't an earnings growth anchor. or an earnings revision anchor. These are just catch-up trades. Now, interestingly, when we saw last year, there were two sectors which were absolutely the worst performers, which was IT services and the second being real estate. So what we felt is this, that real estate broadly, if you were to just contextualize it, is usually when cycle starts, it lasts for 6-7 years. We saw a period of positive activity, and that's because it came after several years of a downturn. And you have a period of digestion. But when you look at earnings growth over the next 1-2 years, they are very different, or rather in a positive sense, still positive and a decent growth compared to what you would have probably seen during the phase of downturn. And you've essentially seen a major correction in terms of stock prices. There's the worst performers last year. Plus, the fact that these are also considered as interest rate sensitive sort of sectors. So as rates continue to moderate, we expect another 50 basis point rate cut this year as well. We think that probably this sector would see some degree of a lift. Remember one thing, that overarching return expectations are not very high for us across the board. So even in a positive return sector, we're not expecting a 30 or a 40% return. It will be better than the 8% Nifty returns.
Okay. All right. Hi, Venu. Good morning and good to see you, Ven. So you're guiding for returns on the Nifty for the next couple of years at around 7.5 to around 8% or thereabouts. And that's how we get to the target of around 28,000. Got that. The other, debatable issue is what's going to happen next and how soon are we going to get a deal with the United States? How big a positive catalyst will that be? And will that alter your view from this neutral stance?
Yeah, so we have factored India-US trade treaty to get signed this year, and that too within the next few months, based on whatever sound bites we've got. Fundamentally, the challenge that I sort of see at this is that it is a narrative or a positive narrative only for a few days than anything else, not more than that. And simply because what we've learned over the last 12 months is very simple, that unless you are, as a country, associated with a particular camp, which is US, I don't think this trade treaty can be believed to be sustainable. It can continue to change through the year. So that's a fundamental issue I have, that that this is going to be just a point trade treaty than anything else. Also remember from a relative perspective that the broader deal with China has continued all the way till November of this calendar year. So it's not that from a relative perspective, we're going to be primarily viewed as a country where FDI should improve, or there'll be massive swath of manufacturing because India identified as the next China plus one. I don't think all of that is going to happen. So this treaty is essentially going to lead to two things. One, a small up move in the market, currency to appreciate a bit, which is rupee, just a bit, when it happens. That's basically it. And the way I'm hedging primarily this particular event is through the IT services overweight trade.
Yeah, that's an interesting viewpoint, right? I mean, so Vinu, what you're saying is you've got to be unambiguously, clearly in the US camp otherwise it's more transactional and it'll go up and down through the course of the year, even if this, some sort of an agreement takes place in the next couple of months.
Yeah, so I don't have to look. I would love to have this as a sustainable trade treaty, but I don't get the comfort today that 2 months down the line something changes. So that policy volatility has been a feature of the last 12 odd months.
Yeah. No, absolutely. Just a quick word, Venu. Lots of global thinkers are of the view that 25 was the year of AI infra kind of names, right? I mean, the actual the chip makers and the data center guys. I mean, physically and otherwise. And now it'll start to turn into, maybe it'll not happen this year, but next year, maybe it'll start this year. It's going to be AI adopters, cost optimization, etc. People are already starting to attribute, different percentages to, growth per se because of this. Cost ration. It's basically at the expense of labor costs. You think that will work out here in India? Have you thought about it? And which segments will benefit the most?
Prashant, the interesting thing is that we are way far behind at this juncture with respect to AI implementation across the board. If at all you're seeing AI implementations in a meaningful perspective, probably happening only in the technology world, which is tech companies adopting it first. Real world implementations are extremely meager. So what it means to me is that this is not a 12-month story or a 24-month story also in terms of being able to generate or eke out enough efficiencies for you to see margins improving or for you to see enough positives that can be deployed by companies to get volume growth. Not at all a story for the next 24 months. I think for India as well as globally, it's going to be a very slow adoption. A lot of adoption probably in 3 to 4 years will become meaningful. A part of that is also because technology itself and AI solutions itself haven't stabilized. So you need to see a situation where corporates are fully convinced that this is what we need to implement.
You don't think,
Otherwise, you don't
financials, for example, financials is the area. I mean, at the end of the day, you need large data sets, right? And who is larger data sets than banks and financials generally? I remember having this conversation with the L&T Finance Management, and they spoke about AI quite a bit and how they've implemented it. You don't think that's a pack kind of sort of which comes up first? They've already adopted in many ways, but maybe it'll get done more.
I mean, we call it AI now. It used to be machine learning earlier. So this is just a change of a name than anything else.
You know, one counter argument for a bullish view on IT is that increasingly companies are still spending a lot on hardware. Memory prices, for instance, now have gone through the roof. They've practically doubled. So basically, they're just crunching what would have otherwise maybe come to services, and that hardware spend by companies will continue. So again, just prolonging when discretionary spending for Indian IT services will make a comeback. But you've also downgraded, Venu, to you've downgraded consumer staples. Now, you know, one part of the camp believed that with the interest rate cuts, the GST rationalization, the tax cut, all this will flow through and benefit the consumer staples. Volume growth will slowly pick up. Rural was anyway doing okayish, but even urban will now show some signs of life. So explain to us the rationale behind the cut in the downgrade in consumer staples.
Yeah, so it's a very interesting theory I had. So I was a bit non-consensus when I upgraded consumer staples sometime in April or May of last calendar year, just ahead of the monsoon season. And broadly, it's about volume growth. It had nothing to do with GST because we didn't really know at that point of time that GST would get cut, but the idea was policy will be pro-consumer. Now, fundamentally, if I were to just think about it, the sector has done nothing much, through the year. Volume growths I guess, will inch up a bit, but not material enough for me to get excited. That's number one. So there will be an inch up in volume growth as you see the quarter or two pan by. But fundamentally, the challenge is that this year, when I look at the fundraising happening in, for example, the quick commerce sector, so Swiggy has raised money, and I think the third largest player is also filed a prospectus for raising money. So a lot of money flow will happen on quick commerce investments, which is not essentially that positive for incumbent consumer brands because it does create a pathway for smaller brands to also be visible in terms of presence. So this competitive angle as well sort of questions and worries me at this juncture. The other part is I don't know how rural and monsoons will shape up this year. Initial sound bites have been very mixed. So that's another concern today. So it's very hard to take a proactive, positive view at the beginning of the year, especially when valuations are not cheap at all.
All right. Venu, one quick word. The RBI has turned pro-growth, right, for the last many policy meets that we've had, the commentary as well as the cuts. How many cuts are you all penciling in for this year?
So for me, roughly 50 to 75 basis points depends on quantum of cuts, but whether it is 25 each. So that's the number that I have in mind. I guess it's going to be difficult to do anything meaningfully beyond this. Part of that is also to do with currency and how well you want to manage your currency.
All right. So 8% CAGR returns on the Nifty. The contra bets will be tech as well as real estate. And in the consumption pack, you prefer discretionary over staples.
So leave us with a slightly upbeat something here. This is like
I call in a very simple way that 8% return is a great return, number one. Number two is this is not...
That's not helping. That's not helping. 8%. Go on. Sorry, I'm joking. Go on. Finish the point.
So I have a lot of buy sectors still, right? Financials is a positive sector. Telecom is an overweight sector. Consumer tech is an overweight sector, and two more sectors, IT and real estate, have moved to a mild overweight. So, I mean, honestly, that's a good enough broader, aspect. The second positive, if at all, is the fact that economy is not like in a very bad shape. Ignore the 8% context of where GDP is, because it doesn't feel like a 8% GDP. But if you look at a lot of data points in the near term as well, things have been okay in the economy.
Yeah.
So we're not falling apart. Remember, this is very different from 2024. We are not collapsing in terms of macro or earnings. We're just in a stable situation. That's basically it. And remember, there's a lot of IPO and fundraising activity this year. Think of it in positive lens. Of course, it does impact valuations for the broader market, but you get a lot of new opportunities to invest in. So if you want to leave on a positive note, perhaps you get a lot more new stocks to assess and invest in this year.
That just sounds like more work to me.
No, absolutely. But yeah, I mean, it's how you frame the question in your head. But, numbers, returns, we will track. And we'll invite you back, Venu, through the course of the year. This is the first conversation of 26, many more to follow. Venu, thank you very much for being here on CNBC-TV18. So that's Venugopal Garre of Bernstein with that perspective on markets. But